When I'm giving talks about funding and whatever, I talk a lot about profitability, cash flow, etc. And I always say that profit's interesting, but cash is everything. Businesses don't go out of business because they don't make profits. They go out of business because they don't have enough cash. It's that simple. You can survive making losses for ages. A lot of businesses, particularly these days, particularly startups, some startup techie businesses go a long time without actually turning a profit. But as long as they're funded properly, that's fine. It doesn't matter cash, but cash is everything. So, the difference between cash and profit. You've got to forgive me, I'm sorry to use baked beans, but it's such an easy thing to do, and it works. So, January, February, March, April, we sell 10,000 cases at £10 a case to Tesco's. We're not going to go at Tesco's. Tesco's are a fantastic company. Says he hoping for more bonus points or whatever you get on it. But you sell them in January, so sorry, that's £100,000 you sell in January. And as we said, the cost of sales, I think we said was 40,000. So that's 40,000. So from a profit point of view, we make profit over here. Sorry, this is another shorthand for profit, pie. Don't know why, just is 60k. So let's just say we get the beans from, I don't know why I keep saying America, but I just presume you make a lot of beans in America. But they're not going to ship them without you paying for them. So you've got to pay for these £40,000 up front. So from a cash flow point of view, so that's profit. So in fact, we'll do profit here. This is a profit. That's the profit there. In fact, that's the gross margin, we said. But from a cash flow point of view, so cash in, cash out. Our cash out is 40 grand here, because we've got, the Americans won't ship them without, well, they won't ship them without us paying. So we're minus 40,000 because, as everybody knows, sorry, that's 40,000. Everybody knows Tesco's don't pay on time. But Tesco's don't pay the month in which you invoice them. They tend to pay, on average, I think I'm right, about 90 days after. So you're probably going to get your payment on the 5th of April, say. Which means you've got a £40,000 cash flow problem here, and you're paying people wages and all sorts of stuff. So it's not a bad thing, because hopefully you've got sales over here to Tesco's that are coming in, and therefore you've actually got a cash flow. But when you start out, this is often a problem. And from a profit point of view, you think, great, £60,000. From a cash flow point of view, you're minus £40,000. And that's the difference between profit and cash. And I know this is a very stark example. You know, you've set up a factory to make this sort of stuff, etc. So I'm not saying don't do it. And what I'm saying is that cash flow is much more important, because when you sell and when you get paid, and there are issues in terms of cash flow, in terms of people like this who take long payment times. One of the things, and I'm not saying don't do it, but there's a thing called concentration. It's really called debtor concentration. If I ran a business before this one, and I used to give personal debt advice to people. So this is people who had personal debt problems, credit card problems, loan problems, etc. And we did these things called IVAs, individual voluntary arrangements. It's a way of paying less than your debt, and paying less debt than you actually owe. You tend to pay about 30p in the pound. And I did some work with a particular organisation, which I can't say, and they gave me they had loads of employees, and I did a lot of work with their employees, helping them, because they didn't want their employees to have problems, not problems like that, as in, you know, there were problems. They wanted them to be focused on working, and then they just changed the way they did it. And probably about 60% of my income came from that one customer, and it wasn't because they didn't like me, they just had a centralisation thing, and it went somewhere else. So I lost 60% of my business just like that. And I vowed I would never, ever do that again. I helped a guy who had a flooring business. He didn't do this floor because I asked him, but this is the sort of flooring he does. Carpets, it's called Antico. It goes into hospitals and things like that. Really clever flooring. And he was in with a large contractor, and we talked before about construction contractors and how they're notoriously bad payers. Contractor went bust, just like Carillion went bust last year. They went bust. He had 30% of his business with them, took him down. And he not only lost his business went into liquidation, but he also became personally bankrupt because he had guaranteed personally guaranteed debts in the business. So he'd borrowed money, personally guaranteed the debt, so he went bust. But to be fit credit to the guy, he started again and got into another business, bought that business off that guy, and is now doing really well. It's one of the, but interestingly enough, what he does, I don't know whether you've heard of this, you can get things called credit insurance. So when he sells to a main contractor his services, and the average invoice value of what he does is about 100 grand to do a floor, to do flooring. If you can't get credit insurance, if he can't get credit insurance on this company, he will not sell to that company. And interestingly enough, he tried to get credit insurance on Carillion, and he couldn't get it, so he didn't sell to them. So when they went bust last January or February, he wasn't caught out. So I'm just going to raise, I just want to talk about this. It's a cost to your business, and I'm not saying, I have no way am I saying you need to do this, because I'm not sure that any of you are in trades that particularly need it, but hey, it's amazing, isn't it? So you do sales, and we've got, turnover, cost of sales, and then he would put in here a credit insurance charge. It was typically a percentage of the amount that he sold, and I can't remember what those percentages were. Let's just say it's 1.5%. So if we use this as 160, he would have then, we'll make it 2%. And 2, so his total cost of sales was 62, so his gross margin was 38. So a little bit less than the 40 that before, I think it was the other way around, but it doesn't make any difference. So if he didn't have that, he'd make £40,000. He felt it was worthwhile paying that extra £2,000 every time, or 2%, in order to credit insure that debt. I'm not saying everybody should do that. I don't do it with my customers, to be honest. But I'd like to think that the people I'm dealing with are fairly safe that I'm going to get the money back from them. But some people do. So, and the reason he did it was because he didn't want to get into that position again of losing his business, which lost his business. He lost part of his house. He had to remortgage, etc. His wife had to remortgage in order to pay some money over to guarantee for these guaranteed debts. So that's why I think cash is so important. Debtors, we've talked, and sorry, the reason I mentioned debtor concentration is because he had 30, I think it was about 30 to 40% of his debtor book was tied up with one customer, and when they went, it just ruined his business completely. We're going to get to depreciation. Well, no, yeah, we are going to get to depreciation in a bit more detail a bit later. But there are things that aren't profit and loss items, things that aren't cash flow items. So, when we've got turnover, 100, cost of sales, you're going to get bored with this, 40, gross margin 60, overheads 30, I think we said, profit 30, that's a minus, that goes like that. Within overheads, that's, yeah, and then cash flow. Things that aren't in cash flow are depreciation. Depreciation is a profit, this is a profit and loss item, this is a cash flow. I'm going to explain when I come to depreciation why it isn't. Depreciation is not a profit and loss item. You do not pay for depreciation to anybody. It's not an invoice that you get, oh, I've been invoiced for depreciation. It's an accounting entry. I'll show you in a bigger example how that works. But also in cash flow, in profit and loss, if you say buy capital expenditure, so say you buy a van to run your cleaning business, it's not a profit and loss item, but it is a cash flow item. So if you spend £5,000 on a van, it comes out your cash flow, but I'll explain when we come to do balance sheet why it isn't a profit and loss item. The balance sheet, right. God, you've got some history on there. I did some research. Who invented the double entry bookkeeping system? And if you have nothing better to do on a night, you can research it like I did. Double entry bookkeeping is just the most wonderful thing because everything has to balance. The whole point about the double entry, have any of you done double entry bookkeeping and double entry bookkeeping? Basically what it means is for every debit there's a credit, or for every credit there's a debit. It doesn't make any difference. So I'm gonna do this because it's worth it. You get things called T accounts, and we'll do cash, and we'll do rent. This is the credit side, debit. Yeah, I'm sure on YouTube there are loads of videos about double entry bookkeeping. If you pay for rent, then what happens is you credit your cash with 100 and you debit your rent with 100. That is an expense, that is coming out of it. That is, well, arguably an asset, and that is a P&L item. You get assets, you get liabilities, and you get P&L items. And the whole double entry bookkeeping is all like this. Every time you do anything, there is a debit side and a credit side, and it has to balance. That's why you have a balance sheet. And if it doesn't balance, you've done it wrong. It's that simple. And sometimes I get really excited when I don't do people's accounts, but even when I'm doing my own accounts, or I do forecast, I do work doing profit and loss forecasts and cash flow forecasts for people, and balance sheet forecasts. When a balance sheet balances, it's just one of the best things ever. I know I should get a life. Yeah, I should get a life. But the point is, I think if you understand it, and I still remember when I first understood double entry bookkeeping. I was an auditor in a firm of accountants, and suddenly it just clicked one day, and from then on, I do T accounts all the time. If I don't understand something, I put it into T account formats. But it says on here, for every debit there's a credit. There are assets. Assets are things that have value. Liabilities are things that you owe. So if you buy, right, we'll do it here, beans, or you order beans from, we won't buy them from America, we'll buy them from here. We'll buy them from Ireland, yeah, trust the Irish. If you buy beans, and say you buy £10,000 of baked beans, but you don't pay for them up front, then they are a creditor, and you owe them £10,000. It balances. That is your stock of beans. That is your creditor. So it still balances. Debit side, credit side. That's what you owe. And that is a liability, i.e. something you're liable to pay. This is an asset. It has value. You have £10,000 of baked beans. Theoretically, you could sell those £10,000 of baked beans for £10,000. I mean, to be honest, nobody can buy them off you because you tend not to get what you pay for when you're trying to sell something like that. The idea of buying these is that you turn these into £20,000 because you put tomato sauce with them and cook them and stuff. But that balance sheets are, so things that are assets are on this. Can you see all this? Yeah. So fixed assets are things like this, chairs, this, computers, equipment, motor vehicles. They are fixed assets. And they tend to be called fixed assets because buildings tend not to move, equipment tends not to move, cars obviously move, but nevertheless they're still a fixed asset. Interestingly, not that interestingly, but we'll say marginally interestingly, within fixed assets you also get things called, have you heard of intangible assets? Fixed assets, so you get capital items, as I say, like motor vehicles, equipment, but then you get their tangible assets, things that you can touch and feel and do things with. But you also get intangible assets, and intangible assets are things that you can't touch, you can't feel, but have value. And those are things like intellectual property, so patents. I think there's been a lecture on patents or not?
That's been to the mentors and the
okay.
mentors taken.
So patents, brands have value, patents have value, trademarks. So Coke, everybody uses Coke as an example of a brand that has a value. It's such a great value within, everyone can draw the thing, or the Nike swirl, whatever it is, that has a value. It is a brand. You can't abuse that brand. I mean, I can't put that on my logo because
Tech Manchester's brand.
Tech Manchester, yeah.
Officially trademarked.
It's there you go.
Christmas.
And it has a value. So, but these are assets that you can't touch. You can't touch a brand. You can't touch anything like that. But it has a value. So that is also. Oh, didn't know I'd done that. Yeah, fix it. So intangible assets, brands, intellectual property, patents. So if you're patenting whatever it is you do, that has a value. And the main thing about a fixed asset is that, and now we're going to come to the really exciting bit of depreciation, but the main thing about is that...
Not often hear those two words in a sentence.
No, you don't, do you? When we paid for our rent, we pay rent on a monthly basis. Yeah, you pay rent on a monthly basis. You get that service for the month. It is a charge for that month. At the end of that month, if you don't pay any more rent, you don't stay. A fixed asset has a value over a length of time. So if you buy a van, and it costs £5,000, you typically wouldn't charge it to your profit and loss account in the month that you bought it. You wouldn't charge it all there because you would expect the value of that van to last not just that month, but the next month and the next month and the next month. And I would say motor vehicles that are used for trade tend to be what they call written off over a three-year period. That's on average. It depends what you do with your motor vehicle. If you pile it in and do gazillions of miles, etc., it could be less than that. If it's not used that much, then if it's maybe a company car, you might write it off over 4 years. So what happens with a motor, as a motor vehicle, as an example, and this is where depreciation comes in, is that, and this is, so if we do January, February, March, April, you buy it in, we'll pick a better figure, we'll call it £12,000, don't know why. We'll call it costs £12,000, and you're going to write that off over 3 years. That means that each year you're going to write off £4,000 per annum. So each month, I'm really glad I did it, you'd do 4,000 divided by 12, whatever that is, 3,300? No, £333. £333, that's your profit and loss account. Every month you charge £333. Because what you're doing is you're trying to spread the expense over the period where that asset is earning you money. The rent, you've only got that asset you've only got the rent for a month, and then the next month, and then the next month, and that's fine. But for an asset, you get a value over a long period of time. In this case, I've guessed 3 years. Patents, I think typically get for about 7 years. Patents, no, you might get longer than that. But nevertheless, you get it for a long period of time, and so you charge your profit and loss account with a monthly amount that tries to spread the cost of that over the period where you think it's going to be of value to you. Your rent is only of value to that 1 month. The next month it's the same. Your insurance is only of value to that 1 month. So your profit and loss account for an asset means that you spread the cost of that asset over the time through which you think that asset is going to give you value. Goodwill. We were talking about buying businesses, and before we remember talking about in the other section we talked about EBITDA, and we said EBITDA, and we multiply it by 5, and we get the value of the business. Let's just call it 5 million. And like you say, yeah, we agree on that. But there's an inherent goodwill in it. There's something valuable in that business that is hard to value. So using Coke as an example, how do you value the brand of Coke? Because let's just say Coke makes, I don't know, £1 billion a year, $1 million a year. So we multiply that by 5. I mean, we won't multiply it by 5. We'd probably multiply it by a lot more. We'll say 10. So we'll buy Coke for $10 billion. But that's just purely financial. That's just numbers. There's nothing in there for the brand of what Coke is as a brand and the value of Coke, what it could give. So a buyer, whoever can afford to buy Coke, might say, well, I'm going to give you £12 billion because I think the brand is worth $2 billion. I mean, that's a huge brand value. But somebody like Coke, I have no idea whether that is the true brand value of Coke. Or Kit Kat, or whatever it is. It doesn't make any difference. It brands. So the difference between the £10 billion that's sort of agreed, and what you actually pay for it is called goodwill, and it's the intrinsic value of the business over and above what you've paid for it. And goodwill can be written off. It doesn't have to be written off. Some people do, some people don't. It's just an accounting entry. I mean, at the level that we're talking about, I mean, the business that I'm selling, that we hope to sell for about 7 million, We're not selling any goodwill. We're just selling it as a multiple of EBITDA. We're not giving. We're not, and we're selling that plus the cash. That's what we're selling. I think it's hard. These guys that we're selling it for, it's hard to sell a brand when they don't really have a brand. The brand is them. It's a weird situation. Stock. I know we haven't really. This isn't a stock business. We've got raw materials, work in progress. So some people value work in progress. So I help the business at the minute that makes a food product, and at any time that they're making this food product, it's a cereal product. So at the end of the year, when we do, well, I didn't do a stock count. They did a stock count. They had stock of raw materials, they had stock of some finished goods, and they had stock of work in progress, i.e. some things they were still making. So it just has a value. And you should always value your stock at the lower of what's called cost or net realizable value. What that means is, if you buy, I don't know, widgets. Everyone says widgets, but if you buy something, I don't know, say a fruit product, apples that you turn into cider. And at the end of the year, you've got some apples that are going off. I'm not actually sure whether that might help with making cider, but anyway, assuming it doesn't, then you should write those apples. You should write off the value of those apples because they don't have any value. So that's why they cost you. Say they cost you £10,000, but half of them have gone mushy. Then you write off £5,000 as a cost because you're not going to get the value out of them. You're not going to be able to turn that £5,000 into cider in this case. So you should always. Most people who have a product do a stock count either at the end of the month or at the end of the year or at the end of 6 months, etc., just so they know what they've got. And they'll look at what they call obsolete stock. So they might have bought product that they normally sell, and then that product's not as common anymore, like flares or whatever. And therefore, you might have to write those down because you know you're going to have to job them out into markets and or car boot sales or whatever. So sell them for less, even maybe sell them for less than what you bought them. Trade debtors. Yeah. So debtors are people who owe you money, who you've sold to and who haven't paid yet. Debtor terms. So typically, a common thing is, 30 days after the month in which you sold the item. Where did that come from? I have no idea. It depends on your trade. It depends on your how valuable you are to your client. If you're really valuable, I was talking to Trish before about a client I've got who clears away sewage. If the customer don't pay, they don't clear it away. And because they do a lot of work in restaurants and bars and hotels and various other establishments, tends to smell, tends not to be conducive to having customers in, and therefore they pay. So they're quite fortunate in what they do, that they have no problem collecting money whatsoever. But there are lots of other people. Construction, as we said, is notoriously bad for it. So the question is I think it's how powerful you are. Some of my clients, I get them to pay up front, some of them won't. Some of them, I don't get them to pay them all what I do up front, but some of them I get them to pay 50%, particularly if I don't know them. I get them to pay 50% up front. And if I can do that, I will, but sometimes you just can't. Debtor days. If your sales, people talk a lot about debtor days. How many days sales? So if you sell £1,000 per day, say on average, that's without VAT. Debtors includes VAT actually, but nevertheless, we'll just say £1,000. And your debtor days are 60. If you've got £60,000 of debtors, people who owe you money, and on average you sell £1,000 a day, then you've got 60 days of debtors. Now, that's fine. Nothing wrong with that. That's not good or bad. It is what it is. If your terms are 30 days after the end of the month, then to be honest, if your month end is there, and you've sold equally through this month, you'd expect payment after 45 days because on average, your average monthly sale is 15 days in here. And if you're only getting 60 days, that means people are taking longer to pay you than what you agreed upon. Now, you should worry if this starts to go up. That's why you should I talk to people all the time about this. Keep account of your debtor days. Look at how long people are paying you, because that's why people go out of business, because debtors don't pay them. And particularly if you've got one bad debtor who's continually not paying or continually late, is that a precursor to them going bust? So the guy that, the carpet guy, the flooring guy, he said he was worried about them, but they were such a big part of his trade, he didn't want to let them down, and then they went bust and they let him down. So look at your debtor days both by, I was speaking to a company the other day, and they don't look at their, they had a report on the system that did this for them, and they don't look at it. And so I got them to run it, and basically what it said was, it was by month, so by customer. So customer was down here, all the customers, and then it said less than 30, less than 60, less than 90, and I think there must have been greater than 90 days, I can't remember now. So they had a lot of current debt that was owed, that was billed but not due, and then this was their sort of slightly overdue, this was their very overdue, and this was their, we have a problem. And there was one big invoice in there for, can't tell you who it was for, but a supermarket chain. But interesting enough, they don't really use this report. And I was a bit surprised, but they say a lot of people just pay them because they trust them and they need their product. So I'm not saying it's a good or a bad thing, but I'm saying is, if it was me, I'd be looking at this all. I look at my debtor book all the time, and I chase people if they don't pay me. And I think, particularly when you start, if you get into the used to it, of you don't even have to be chasing them, just ring them up and say, you know, how's things going? I presume my payment's going to be coming through on Saturday, etc., etc. That's what I do. Debtor concentration, we've talked about. Invoice finance, anybody here do invoice finance? Or? Debtor, right, invoice finance. This is 10,000 baked beans to Tesco's, £100,000. We said it's cost us 40 grand, we've had to pay that money out front. So we're minus 40,000 today. And we know that Tesco's aren't going to pay us till April, okay? But we know they'll pay us because we've delivered it. We said we've delivered exactly what they wanted for the price, on the day, at the time, because Tesco's are like that. If you, God forbid, you deliver it late. So we know we're going to get paid, and we've got an invoice for them. Invoice finance is effectively borrowing against that invoice, and typically you will get 85% of the value of that invoice up front. So in that case, you could effectively you sell the debt to an invoice finance company. So you get £85,000 in. So suddenly you've gone from minus 40,000, you've got 85 grand coming in now. So you're plus 45,000, yippee-dee. But you've got to pay for that because somebody's lent you the money. So you generally pay sometimes a management charge and certainly an interest charge until Tesco's pay you the 100,000, and then you have to pay back the 85 grand plus interest plus a management charge, etc. But there's nothing wrong with doing it, but there's a cost of doing it. A bit like we said with credit insurance, there's a cost of that, there's a cost of this, so your margin will be a little bit reduced. Loads of people do this in loads of different trades, not just product, but in services as well. It works well when you're growing, you've got a growing business, because sometimes it's hard to fund, and you don't know, it's not like, because the alternative could be, well, I'll borrow 85 grand. But then if you borrow 85 grand, you've got to pay that off over a period of time, and you don't know the way your sales are going to go. The good thing about invoice finance, it tends to grow with your business, but it's not cheap. You know, it isn't a cheap form of finance. And there'll be certain customers they won't do it for. Not Tesco's, because they trust Tesco's, but there'll be certain customers that they don't like. If all your business was with Tesco's, they'd probably worry about it because you've got this concentration problem. So I'm not saying it's a good or a bad thing. It is just a thing. It's a way of funding your business. Bad debts, bad debt provisions. This is we talked about this really about if you think you're not going to get. Oh no, that was to do with stock. Yeah, if you thought in your accounts, if you think you're not going to get paid by a particular customer, then you should what's called provide for that debt. So effectively, whereas your turnover was 100,000, and of that 20,000 you're a bit worried about getting the money, you should effectively write off that debt. But it's not you don't reduce your turnover, it's a cost down here in your overheads. It's a cost that you put in. So you're not paying that money out, but it's an accounting entry. And obviously if they do subsequently pay you, then you reverse that cost, and if they don't, then you've accounted for it. Prepayments, it's an accounting entry. If you pay for something, sometimes people pay insurance up front, so you might pay, I don't know, 12 grand insurance for a building, bad example, but nevertheless. You could, just like the van, you could charge that all in the first month in January, £12,000, or you could spread it £1,000 each month. That's what a prepayment is. It's where you spread a cost over a period of time because you're going to get the value of that insurance month on month on month. Creditors are people who you owe money to who have either not invoiced, haven't paid for, but for which you haven't invoiced. Yeah, so you've bought your baked beans, you've ordered your baked beans, they sent you an invoice, they sent it with the goods, but you've not paid it. That, at the end of the year, that is a creditor, or the end of the period, that is somebody to who you owe money. Just like debtors are people who owe you money, creditors are people to who you owe money. And it is you have to pay that. So you have to account for it. But it could be the case that they haven't actually invoiced you, but you've had the service. So it could be they're just late. You buy something on the 31st of December, you don't get invoiced till the following year. But you know you've had that service, or you know you've had that good. Then you should that's what's called an accrual. And you basically, so if your year end is the 31st of December, you've had the service here, but you haven't received the goods, you haven't received the invoice till here. What you should do is you should put that invoice into that year, because that's where it goes. That's where you've had the benefit of that service or good. It's called an accrual. Overheads and overdrafts and loans, they are a liability. So liabilities are things that you have to pay. So liabilities are things like tax, VAT. You'll be accounting for your VAT on a quarterly basis. Corporation tax. So we said we made 30 grand in that business, didn't we? And we said the corporation tax was £5,700. We have to account for that, and at some point you're going to have to pay it over to the HMRC. And typically it's 9 months after the end. If you're accounting year end is 31st of December, I think it's 9. I can never remember if it's 9 or I think it's 9 months after the end of the tax year. Not the end of the tax year, the end of the accounting period. It's not the end of the tax year, really important. It's not the end of the tax year. It's 9 months after your accounting period finishes. So my accounting period finishes on the 30th of November, and I have to pay at the end of August, so 9 months. So you need to make sure in your cash flow that you've got £5,700 to pay. Tax due, directors' loan accounts. Directors' loan accounts, yeah. Typically, when I set up my business, I took a deal from a company I was with and got some money, and I put that into this business. And I put it in as a director's loan. So basically, I'm now going to go back to double entry bookkeeping. This is cash, this is bank, cash and bank. I put in £30,000 here, that's a debit. And on the director's loan account, which I set up, the business owes me £30,000. Debit, credit, balances, you see. And there's nothing wrong with doing that. And you could say, well, you could get interest on that if you wanted to pay interest. Or most people don't. Most people just pay it back out of when you start making a profit in the business, start making some cash in the business, you pay it back, but it's not taxable because you've put that money in. That's out of taxable revenue. You've already put that money in. So so say each month you reduce that by £1,000, or say £5,000. You pay it off within 6 months, and that will reduce 5,000. So that's now the balance on that account is only 20,000. That's what's called a director's loan account. It's used a lot to fund businesses. The business owes the director that money. And we've got fixed assets, stock, debtors, cash. So I'm just making these figures up, obviously. 10, 20, funny enough, 30, and 40. That comes, so your assets are 100,000. Your liabilities, we said, were creditors, trade creditors, tax. That's all we'll have in this particular case, which comes to 30,000 and 40,000. So that comes to 70,000. So we say, well, that doesn't balance. But down here, you've got what's called capital and reserves. And this is basically the ownership of the business. And in here you must have had a profit and loss reserve account of, so that's 100 less 70 is 30, and that equals 30,000. Okay? And I would just explain how this would work. If this business stopped today, we'd sell the assets for 10 grand, we'd sell the stock for 20, we'd collect in £30,000 of cash, and we've already got £40,000 of cash. So our bank account says, yippee-dee, £100,000. But out of that £100,000, we've got to pay £30,000 of creditors. We've got to pay tax of 40, so we've got £70,000 to pay off. So that leaves us with £30,000, and that is basically the value of the business to the person that owns the business, and that's him paid off. Or no, we're
not the 100,000 at the top.
no, it's the 100,000 less the liabilities. It's what's called the net assets of the business. The net assets will also always equal this what's called the capital and reserve section at the bottom. If you go on any I don't know if you know, you can go on company's accounts, company's house. Anybody can go on company's house, and you can look at anybody's. Well, you can look at anybody's accounts. You have to file accounts every year, but you don't have to file. Some people file full accounts. Some people file I can't remember abridged accounts, and it depends on the value. It depends on your turnover and the assets in the business. The value, theoretically, the value in that business I said was 30 grand. But there's a difference between sort of closing a business down and realising all the assets and paying all the liabilities to selling a going concern. You know, we're talking about EBITDA and how you value a business. This business could be sold for much more than 30 grand, maybe. It depends on the underlying profitability of that business, the EBITDA, and it depends on as I said before, the trade and the team and the history, etc. But if you just actually stop that business today, because balance sheets are all, I said profit and loss accounts were accounts for a period of time, for a month or a year to 31st of December. A balance sheet is a balance sheet as at a specific date. You look at all accounts on Company's House, it will say the balance sheet as of the 31st of December. It's only on one day. The rest of the year doesn't make any difference. It's the balance sheet on one day. And so if this business stopped on this day, theoretically, that's what would happen. In practical terms, it probably wouldn't, but that's theoretically what would happen.